This lecture was a bit of a challenge, actually, for me to put together because it's not often that I talk about Australia. So what I'm going to do is sort of try to put Australia in the context of a lot of the work that I'm actually involved in so that we can try to understand what sorts of things might influence outcomes for Australia going forward. And as I was putting this talk together, I realized that there are a lot of similarities between Australia and other parts of the world. One thing that I think really sort of sets Australia apart, and I joke about this with one of my colleagues who in fact is Australian at Rice, is that the country seems to be tripping over resources. And that's a very unique problem to have, so to speak. So you'll see throughout this talk elements of that theme and what that might mean going forward. Okay. So the first thing that we have to do when we talk about global energy balances is we have to put Australia in the context of the world, right? It would be one thing to stand here and talk about Australian resources and Australian trade partners and what that might mean and how it might change going forward, but to really understand where opportunities and potential pitfalls may lie, you have to put it in a global context. One of the things that's definitely true about global energy markets is they are becoming increasingly global. The oil market sort of long since sort of crossed that hurdle, but natural gas is increasingly becoming more and more, or I should say less and less regionally distinct and more global. Heretofore, natural gas markets had largely been characterized by three distinct regional markets: Europe, Asia, or the Pacific Basin, and the United States, or North America more generally. That has been challenged a bit, in particular by growth in liquefied natural gas trade. Shale gas, which is something I will talk about in just a moment, has only furthered the move away from these sort of regionally distinct markets because by displacements, it's creating opportunities for arbitrage. And those arbitrage opportunities, if they're allowed to be capitalized upon, will be, and that generally means that trade ensues. Now, when we talk about global energy markets, it's very important to realize that there's more than just fossil fuels, right? It's not just oil, natural gas, and coal. There's also nuclear, there's hydro, there's what we call traditional fuels, which would be things like biomass that typically less developed countries actually use quite a bit of. But then also the renewables that we think of as, in a Western sense, if you will, wind, solar, these sorts of things. The things that are tradable are the ones we're going to focus on in this context today. So those are largely the fossil fuel resources. So coal, oil, natural gas. It's not crazy to just focus on those anyway, particularly when you're thinking about the next 2 decades, because quite frankly, fossil fuels comprise about 85% of global total primary energy demand. So it is, by and large, the majority of what we consume. The renewables, nuclear power, those are generally not traded commodities in the sense that they're traded internationally unless you have contiguous borders. So, for example, hydropower is actually traded from Canada into the United States. But in terms of a broad sort of international context, it's not the case. And certainly for Australia, it wouldn't be. So what I'm going to do is focus a little bit on those sort of fossil fuels that Australia is in particular involved in trading in terms of exports would be natural gas and coal. But I'll talk a little bit about oil as well, because indirectly that does impact what happens in Australia longer term. But then what I want to do is sort of, after we've sort of set the context, is talk about transformative events. What do I mean by that? Well, one only has to think back through the last 10 years to think about a very transformative event in energy markets, and that has been what's been going on with shale gas developments in North America. It has dramatically changed the landscape of natural gas on that continent, and it actually has had some pretty wide and far-reaching impacts. It has triggered an interest in exporting LNG from the United States, which is an attractive proposition to some major LNG buyers in the Pacific Basin, largely because it means they'll be linked to liquid hubs in North America. That moves away from the traditional oil index pricing paradigm and has dramatic implications directly for what's going on in Australia. When we sort of move beyond just the transformation that has occurred due to shale, we can start to think about, well, is this matriculating into other areas? And it certainly is. What we typically refer to as light tight oil is just shale oil. It's basically a very similar formation to what we think about when we think about shale gas, but we actually get liquids. This is something that has, in the last couple of years, really started to take off in North America, and it's got people every bit as excited as shale gas has gotten people excited. So it's very much a transformative event. You've seen a renaissance in oil production in North America, and there's no reason to believe, to the extent that we can identify similar resources around the world, you won't see that elsewhere. In particular, China, which is a very important sort of target market for Australian resources, has identified shale gas resources and identified light tight oil resources. And so you have to think about, if prices begin to rise or continue to be as high as they've been, will that or won't that put in place the proper incentives to, either through policy or through the allowing of markets to actually operate, through foreign direct investment or whatever, to see those resources developed. If it does, it actually could be every bit as transformational as what we've seen in North America. And that has direct implications for Australia. Of course, on the shale front, Australia is not sort of just on an island, so to speak. There's shale here too, right? So not only do shale developments potentially impact Australia in a negative sense in terms of minimizing target markets for resources, but it also could impact it in a very positive sense, because it actually sort of adds to the pool of resource that Australia has to draw from for exports or domestic production, manufacturing basis, so on and so forth. So there's a lot to be said about shale, and ultimately, and I'll have a few more words to say about this in a few minutes, but ultimately what will promote the development of resources in one place versus another are things that are above ground. They're not geologic. There are things that are above ground related to regulatory structure, related to policies that ensure responsible development of the resource. So these sorts of things are very, very important to understand, because it can actually give one region a comparative advantage over another when it comes to resource development. Then beyond that, we have to think about the coal arena a little bit. And there's actually something going on in the United States that potentially has a very dramatic impact on coal trade in Asia. Namely, there are a set of rulemakings that have been passed down by the U.S. Environmental Protection Agency that target largely coal facilities. In the last rulemaking, a lot of older coal facilities were grandfathered, so they didn't actually have to comply to the last rulemaking, which was in the early 90s. It was related to SOx and NOx emissions, so air pollutants. The latest rulemaking has nothing to do with CO2, but it, in a lot of circles, is being viewed as a way to sort of backdoor CO2 regulation without actually directly regulating CO2. In effect, what it's done is it's sometimes called MACT, which is maximum available control technologies. Those technologies have to be adopted by all operating power plants in North America. So these are control technologies geared specifically to control emissions of these types of things like sulfur dioxides, nitrous oxides, particulate matter, so on and so forth. Plants have to come into compliance between 2013 and 2018. If they don't, they have to shut down. It's really that simple. There are no plants being grandfathered in under this, and this actually has posed a threat for a lot of the older facilities because the retrofit costs are actually quite prohibitive. And by some estimates, you could see up to 20% of domestic coal capacity shut down. Now that's kind of a scary thought when you think about what are we going to do about electricity demands? But it just so happens there's a lot of natural gas-fired generation that is actually rather heavily underutilized that could step in to fill the void. So it's not as scary a proposition as you think, but it has direct implications for natural gas demand in North America. And you have to think about, well, if we're not burning coal, what are we doing with it? The United States coal market is massive, and the coal lobby is massive. They're not just going to lie down. As a matter of fact, there are already plans to expand export facilities, support facilities to export coal, largely targeting Asian markets. That has a direct impact on Australia. So there's a lot of connectedness that emerges when you start to think about how these different sort of transformative events might actually shape the future. So in the global context, let's just look at demand. And these are useful sort of pictures. It's just a collection of historical data. I sort of aggregated some regions and tried to highlight the big countries, if you will. And I tried to put a little arrow there. You can see Australia. I'll actually walk over here and point it out. All the graphs are set up the same way, so this will be pretty easy to follow. See Australia here is this thin red line. Okay? This is global petroleum demand. From 1980 to 2010, you can actually see the large countries. It's dominated by the US and Europe. Asia, however, is a large source of growth. You can see China, that's that pink bit just above Australia, and then all other Pacific Basin countries is that large sort of dark red bit at the top. But the point is, when you look at Australia in this context, you see, well, in terms of global petroleum demand, it's not a major player. Okay? Natural gas demand, same kind of story. When you look at natural gas demand, you see it's actually consumed in a lot of different countries. The actual amounts in individual countries is not that large with the exception of a few. In particular, if I look at the European continent, I see that demand is quite large. If I look at the United States, demand is quite large. If I look at Russia, demand is quite large. So Russia is this sort of yellowish. Here, this is the US, all the greens are Europe. When I go sort of beyond that, though, I see there's quite a large collection of countries that consume gas. Australia is the thin red line sort of buried in there in the middle. That's the little arrow pointing to it. So it's not large on the demand side. Coal demand. Again, you can see Australia, it's this sort of red bit here, not large in a global context. And the really striking thing about coal demand is you actually see much less diversity in terms of its use across different countries. The picture is heavily dominated by two countries in particular, the United States and China, right? And the thing that's really wild about this, I'm going to come back to this later, is look what's happened since roughly 2003. China has sort of taken off. And that's had direct implications for the Australian coal industry, as well as a growing coal industry in Indonesia. So what about on the supply side? Let's just run through these real quick because it's going to allow us to talk a little bit about how trade between these countries actually matriculates. You can see here on the supply side, a lot of diversity. As a matter of fact, among the fossil fuels, petroleum supply is the most diverse. And you'll see that in just a minute when I show you gas and coal. The picture, however, is dominated largely by the United States, by Russia, and by Saudi Arabia. Those are the three largest petroleum producers in the world. Saudi Arabia is interesting in this context because they export a lot. Russia is interesting in this context because they export a lot. The US is not so interesting in this context because we import a lot, right? That just goes to sort of speaks to the point that we saw a minute ago when we looked at demand. The US was a very dominant feature on the demand diagram. If I'm looking for Australia, you actually see a very thin red line again, right? Matter of fact, it's not a net exporter of crude oil, so not a big story to tell on the oil side. On the gas side, you can see Australia a little bit more prominent in this picture. And I'm going to come back to this point in just a minute, but when we look at supply on the gas side, it's largely driven by, this is North America, the blues here, this is Russia. Pretty much everything else are just sort of bits and pieces that fill in the gaps, okay? On the coal side, and this is where Australia becomes suddenly very prominent. Okay? You can see Australia stand out very clearly here in terms of global coal supply. So in the global arena, particularly with regard to coal, Australia is particularly important. Now, one of the things that should be sort of jumping out, particularly in the coal map, or coal picture, is that supply and demand look very, very similar. That largely owes to transportation costs associated with coal. Typically, if you have coal, you consume it. Australia is a little bit unique in that it exports a lot of this. China, you can see, producing a lot of coal, consuming a lot of coal. As a matter of fact, it's consuming so much it has actually turned to import. So we can actually talk a little bit about trade. On the gas front, very interesting point. You can see Australia, it's a little bit more prominent on the natural gas trade front. I'm going to come back to this point in just a minute. It actually stands to grow quite a bit in the next few years. Okay? How is it going to grow? Well, certainly not through pipeline exports. It's all in the LNG arena. As a matter of fact, if I showed you a similar picture that just showed you LNG trade, you'd see Australia in a much more prominent sense because it occupies almost 8% of total traded natural gas that's traded via LNG. In terms of all internationally traded volume, though, it's on the order of 2.5%. Okay? Why is that? Well, because a lot of trade is represented in this yellow bit here. That's Russia to Europe. A lot of pipeline volume. Coal exports by country. And this speaks to the point I was making a minute ago. Australia is fairly unique. This is all internationally traded coal. You can see Australia is very prominent in this picture. A lot of growth recently, in particular out of Indonesia, which is actually quite interesting. And if I actually look at this, I'm going to come back to this point in a minute. I look at the United States over a long history. There actually have been periods where a lot more coal was exported from the United States. There's been a bit of an uptick since 09. If I showed you 11 and actually the first bit of 12, you'll see this continues. I'm going to show you that in a few minutes. And what that really speaks to is what's going on in the United States with regard to natural gas competing at the margin with coal. It's actually pushing it off the stack, which is an interesting development, to say the least. So there are some key points here that I think are going to be the themes of the remainder of what I'm going to say. First, when you just look at those pictures, it doesn't really look like Australia is a large player in global markets, with the exception of coal. Global energy markets, that is, with the exception of coal. But it's actually poised to see a lot of growth in natural gas. Now, why is that? Well, there's some projects that are already in the pipe. We know about those, right? Things that are under construction do come online in the next few years. You'll see LNG exports from Australia grow. As a matter of fact, a lot of people project LNG exports from Australia to surpass Qatar in the next few years. And I'll show you some more data later to support that. But why is that happening? Despite the fact that Australia is one of the highest cost places in the world to build a liquefaction facility, it's still attracting a lot of investment. Stable investment climate has got a lot to do with that. Access to the resource has a lot to do with that. And location, location, location. Okay? Australia is very well suited to meet the region of the world where demands are projected to grow the most radically, which is Asia. Okay? And so transportation costs are actually a bit lower if I'm here versus in West Africa. Okay? And my target market is China or India. So these things actually play to Australia's advantage. One thing that may seem a little bit troubling, sort of from afar, is how tied at the hip Australia seems to be with China. And I'm going to show you more and more information that begins to support that, because one of the things that we always talk about when we talk about sort of investment theory, for example, is you don't want to put all your eggs in one basket, right? Portfolio approach is the safest way to diversify risk. Well, you have to ask yourself the question, well, what if the train derails in China? What does that mean for the Australian economy? Could mean a significant amount, to be blunt, okay? So, whether or not, that risk is internalized and there are methods that are sort of employed from the policy standpoint to try to deal with that, that's a different conversation, I think, right? Really all we're doing is pointing out the fact that the two countries are very much linked. Okay. The last point that again, we're going to go through some very key points, transformative events that I think in the next 20 years or so could really spell a lot of change for energy markets, is transformation always happens, right? The one constant in the world is change. That's a very old sort of cliche, right? But that's something that will always, always, always be true. Okay? So just when you get comfortable with the status quo, just when you get comfortable with the consensus, you shouldn't be comfortable anymore. Okay? First transformative change we're going to talk about is the shale gas revolution. If I go back 10 years, consensus was that the United States was going to be a major importer of natural gas via LNG. Well, we all know what happened to that story, right? Consensus was wrong. Consensus was wrong largely because shale occurred. Now, if I look at this picture, this is a good way to sort of understand why that consensus existed. This is a composite of satellite photographs on clear nights around the world. You can see the continents, you can see where the lights are on. There's little white dots on all the continents. Those are important to recognize because that's where we consume energy. The other thing that's layered into the picture, and these are these blobs of color range from a bright red down to a sort of a dim purple that almost disappears in the background. Those are areas of conventional gas resource. So we haven't touched on shale yet. We haven't even gotten into the unconventional space. But the brighter the color, so the redder, the more intensely endowed the region is with conventional gas resource. So the thing that should immediately jump off the map at you is that the biggest, brightest red spots on the map are nowhere near where the lights are on, right? And if we think about natural gas as an important source of energy for electricity generation and getting all these lights to turn on, we then have to turn our minds into thinking about long-distance transportation. And that's where you get into the realm of thinking about LNG from West Africa, LNG from the Middle East, LNG from the Barents Sea, Stockman developments up in the Barents Sea in Russia. Northern Russia. Long-distance pipelines from Western Siberia into Europe, and Western Siberia via something called the Altai Project, which actually follows a mountain range down into Western China. All these things have been and were proposed. Well, all the LNG projects that I mentioned actually had a vertically integrated structure. So a lot of the majors were involved in upstream developments to basically produce gas, move it to a liquefaction facility, put it on a ship, and send it over here. Okay? Lots of lights, no red, right? However, we fast forward 10 years, and we can layer shale into this picture. It has a very important locational aspect. Namely, if I look at where shale is, it just so happens that it coincides in a lot of places with where the lights are on. So if I can produce that and meet these demands, say in Eastern United States, or in Western Europe, or even in China longer term, that reduces the amount of LNG that I need, ceteris paribus, right? So all else equal. So this has very much been a transformative event. As a matter of fact, when I look at what's been going on in North America, the rush to build liquefied natural gas receiving capability was absolutely astounding. In 2002, there were over 47 different terminals that had received certification for construction. Nobody thought they'd all get built, but it was a clear signal. We did see capacity, import capacity, increase from roughly 2.5 BCF a day to over 17 billion cubic feet a day. Most of that capacity sits idle today. Why? Because shale gas happened. So ex post, bad idea, right, to build all that import capacity. But again, that's a transformative event. And it's had ripple effects because a lot of the stuff that was being done in Western Africa and the Middle East was being done in a vertically integrated way to target import facilities in the United States. Now that supply, it's available, but it's not coming to the US. As a matter of fact, back in 2009, sort of after the great financial crisis, we had a lot of reduction in demand, but a lot of that capacity was coming online. LNG capacity was coming online. You actually saw spot LNG prices dip dramatically all over the world. As a matter of fact, spot LNG markers in Asia were only $4.50. Significantly different than the oil index price that most contracts are negotiated through. One of the things that has sort of, I think, masked what shale's done a little bit was a very unfortunate event. It was the Fukushima disaster. Because as soon as that happened, the Japanese have since shut down every nuclear reactor in the country and bought up all the slack in the LNG market. You have to ask yourself, long term, is that really the way it's going to be? It's a good question, right? But again, Fukushima was a transformative event. It was unforeseen, right? But it certainly changed the way we think about and make investments in the natural gas world. So it's led to a paradigm shift. When we talk about shale gas, don't think I need to read the slide, but a really key point. We actually at the Baker Institute released a study in January of this year where we looked at shale gas opportunities in China. And we basically varied the amount of resource that might be available because quite frankly, there's still a lot of uncertainty on that front. And one of the things that we showed is should there actually be a lot of success on the shale gas front in China, it could be every bit as transformative for the Pacific Basin that what's happened in North America has been for the Atlantic Basin. And that's a lot to bite off, particularly if you're developing LNG projects in Australia. Still evolving state of knowledge. We're still learning as we go. That's a very important point, because when we think about shale in the rest of the world, it could have very far-reaching implications, but we're not really going to know until we reach out and touch it, until we do. Okay? It not only has implications for the way gas is traded, it also has implications for pricing paradigms. So will oil indexation persist? It's a very good question, right? Typically the things that can violate the notion that, or upset the notion that those paradigms will persist is a significant change in the elasticity of supply. And that's actually something that we've seen in the United States. In particular, if I look at the impact of shale on price, we actually did a study, and this is in effect how we've been able to derive how the elasticity of supply has been affected by shale. We did a study for the United States Department of Energy where we actually looked at a counterfactual. We sort of simulated the world as most people viewed it back in the early 2000s. There's no shale. And we compared that to a world as most people view it today. We know where the shale is, we know what it costs to develop it, so on and so forth. And what you actually see, and these are decadal annual average prices at the Henry Hub, is a dramatic difference in the realized price of Henry Hub. As a matter of fact, as we slide out to the 2030 to 2040 time frame, you see prices are close to $3 lower simply because shale is in the mix. You can use that information, compare it to how demand's actually shifting, so on and so forth, so you can track out what's going on with the long-run supply curve, and you see that the elasticity of supply with shale is roughly 5 times greater. So what that does is it injects liquidity into a system. If you can inject liquidity into a system, not only do you increase competition, right, but you also threaten to disrupt what people typically think of as a consensus view of pricing paradigms. In particular, if you can see this phenomenon matriculate into other countries, other places around the world. And that's really the point of this picture. Shale is everywhere. It has been identified. As a matter of fact, in the United States, we've known about shale forever. Okay, it's not as if this was sort of something that we discovered. Making it commercial reality, that's what's new. Okay, there's an innovation that occurred in the upstream that allowed this thing to happen, and it happened very quickly. Now, when we look around the world, we can ask the same question: will it happen in other places in the world as quickly? Likely not. There are lots of reasons why that's not the case. A lot of them owe to the regulatory environment. When I say that, I use the word loosely because I'm really talking about market structure. I'm talking about the regulatory frameworks that govern transportation, that govern the sale of leases, that govern mineral rights. Lots of things are involved here. In the United States, one of the things that's very true is you can negotiate, if you're an individual company, directly with the landowner for the rights to the minerals underneath their homesteads, okay, underneath where they live. Elsewhere in the world, it's not the case. Okay? The government is intimately involved in that process. Changes the nature of the conversation quite a bit. Other things that are true, so for example, if I go to Europe, transportation capacity on pipelines is not unbundled from ownership. So what that means is that if I own a pipeline, let's say I'm Gazprom and I own a large pipeline, the Yamal system through Poland all the way to the German border, I can effectively block entry onto my system. What does that do? It presents a barrier to entry into the market. And so that can delay the development of shale in those parts of the world as well. So yes, shale is a transformative event. We've actually done some work to see what it actually means. This is in effect a result of a simulation where you see shale gas production does grow quite a bit. I think the most interesting thing that you see for Australia is really the bottom bit here. This is China in the red. You see growth, and that growth in production of shale is really commensurate with growth in demand in China. As there's stronger pull for natural gas resources, you'll see domestic production endeavors rise. You can see India growing here, and this purple bit is an interesting one as well. That's Australia. Right? Matter of fact, what happens long term in our reference case modeling results, and I haven't really talked about the model, I'm not going to. So important caveats, I sort of mentioned these already, right? But there are lots of things that could keep shale gas developments from taking off the way they did in the United States. So if you look at countries like China, if you look at countries like India, look at countries in Europe, there are some places in Europe, for example, that have already initiated bans on hydraulic fracturing. France, Bulgaria, Africa even, South Africa initiated a ban on hydraulic fracturing. So there are certain places where there are identified shale resources, they're just not going to get off the ground until something really changes, right? But then there are other places where those bans don't exist, yet there might be barriers to development that do. And this goes back to a point I made a minute ago when I talked about the relative attractiveness of different regions for resource development. Australia might actually look a bit more attractive should there be capability to export natural gas in large quantities to China than, say, developing shale gas resources in China. This might be related to maintaining intellectual property rights to the technologies that are actually employed in the field, access to the minerals in terms of who owns the mineral rights, who owns the majority of these mineral rights, who can actually come in as a joint venture partner. Do you have to partner with a domestic firm, or can you actually come in and win the rights to develop without having to do so? Now, all these sorts of things, change the nature of the way firms think about entry into any market. And certainly I would say at this point, Australia sort of wins the battle on all those fronts. The one thing that really I think hurts Australia is how expensive it is to do anything here right now. When you hear about things like, and I'll just use the Ichthys project, which is a LNG project up in the Northern Territory, $35 billion. Yes, there is interest from Asian buyers. Yes, they have indicated a commitment to move forward on that project, but I would be willing to bet you that that project will be upside down before it's ever done. That is very, very expensive, particularly given all the other things that are happening on the gas front. If you think that you're going to get $15 gas long-term in Asia, and we know that shale is there, you need to think again. Because a lot of people thought you were going to get, I showed you the price of Henry Hub projections, between $6 to $8 gas at Henry Hub, and that's why you could bring LNG into the United States at a profitable basis long term. Well, prices actually rose a little bit, and what happened? It triggered a lot of upstream activity, and lo and behold, that reality didn't come. So you always sort of have to stay on top of this. The other thing that is really interesting, I think, about just the upstream sector in general is, and this is, I don't know what it owes to. Maybe it's the emergence of social media. Maybe it's the emergence of media and the sort of lens it focuses on the energy industry in general. But certainly now firms can't just think about the physical engineering of projects anymore. They have to think about the social engineering of projects. And you're seeing this in the United States in a lot of places where there'll be town hall meetings, firms will come in, they'll talk about the benefits associated with activity, they'll actually do visual demonstrations of what hydraulic fracturing means, types of casings that are put in place, so on and so forth. These sorts of activities are becoming more the norm, right, than the exception. Okay? And it's because there is concern, public concern that is voiced, expressed, and if it's not met and dealt with, then it will ultimately lead to blockage of the activity. And so these are the kinds of things that the energy industry really has to stay on top of. What's the next transformative resource? Yeah, absolutely.
Argentina is an interesting question. We've seen nationalisation.
Yeah.
China, there could be an expectation if the resources is excellent, there'll be a move to bring that home to Chinese ownership. Yes. How do you see these nationalisation type events impacting the growth on shale gas? Do you see it slowing it down because of the dislocation?
Absolutely, I see it slowing it down. Firms in general, I mean, talk about Argentina just briefly. Repsol, you ever heard the expression where there's smoke, there's fire? Okay. Repsol was at the middle of what happened in Bolivia a little over a decade ago too, right? And so you have to start wondering, are they doing something that is upsetting the local government? And I think it's a reasonable question to ask. I don't have the answer. right? It's not something I really studied in a lot of detail, but it is a question you have to ask. And when you ask that question, you can look at other firms' interest in Argentinian shales. Vaca Muerta in particular is an oil-bearing shale that a lot of people are interested in Argentina. It's got a lot of interest from the majors. ExxonMobil still, had an announcement the other day. They're still gung-ho. They're going after it, right? They're going to have to work with YPF. Exxon buys a lot of options. They don't always exercise those options, and they're big enough to do it, right? When you have a balance sheet like that, you're big enough to do almost anything you want. But so whether or not they'll actually move in a rapid fashion, I think is going to be very much contingent on how they have to proceed along with YPF in terms of development of the resource. That's still very unclear. As a matter of fact, the Kirchner government really hasn't laid any ground rules out. And so that uncertainty, and that's really the point, right? Uncertainty creates delays. Yeah. That's really the bottom line. On the China front, as well as I do, there are a lot of firms that are nervous about going in there. And a lot of it is related to uncertainty. There are companies that, engineering firms that have had designs stolen in effect over the last 20 to 30 years. And the last thing any upstream operator wants to have happen is to make a big investment in the development of shale and then, in effect, be kicked out or denied access to continued development because the local NOC said, we can do this. We know how to do it now, right? So yes, I think that does create a lot of uncertainty, but by the same token, the prize is so big. You're sort of doing the risk-reward calculation, and right now the reward's winning out, I think. So I still think you're going to see some movement in that front. Some of the biggest issues facing China really aren't that. They're more to do with water resources. I don't have it in this presentation, but there's a nice map that I've used to show where there's issues of water scarcity in China and where shale resource basins lie, and they coincide almost perfectly. Now, the typical Chinese way to deal with this is an engineering solution. We'll build pipelines from point A to point B and move as much water as we need to, right? Rather than sort of engage a conservation sort of tactic. That won't work in the long run. As a matter of fact, there have already been conflicts, regional conflicts over water in the location of communities in China. So, if you start to add that stress to the system, it's going to be interesting to watch, let's just put it that way. On the gas front, I only mention this because it's an area in which I know there's a lot of very active research going on, and it's an area that could really disrupt the way natural gas is traded globally, and that has direct implications for Australia. Methane hydrates. When you think about shale, right, we've known where shale exists for a long time. It was always an issue of making it a commercial reality. Took a few process innovations. As I've used the example, it's like an assembly line, right? The technologies are known, you just sort of put them together in the right way, and lo and behold, you have something that works. So horizontal drilling was not new, hydraulic fracturing was not new, but combining them in the way that we've combined them to develop shales, that was new, made it commercial. Well, hydrates, we know where they are. Okay, we've known where they are for a long time. It really is right now an issue of how do we make it commercial. Okay? Hydrates are crystalline structures that have methane locked up in them. The trouble right now is how do I go down to a crystalline structure and not basically destroy it and get a methane release without being able to capture it? Well, there's been some effort ongoing in this front, and some of the initial test results have proved pretty promising. Matter of fact, there was a recent test well where they actually injected CO2 into a hydrate formation. What it did was it displaced the methane, so it stored the CO2, released the methane, and captured the methane. So you're sort of killing two birds with one stone, so to speak, right? So interesting technological innovations that are occurring on this front. Does this sound familiar at all when we think about shale? Right. The thing that's really interesting about hydrates is it could be really, really transformative, not just for gas, but everything. Because there are so many hydrates. When you look at the hydrate resource that's been estimated around the world, it dwarfs all known natural gas consumption and known gas resources combined. So you're talking about something that would truly be transformative. If we figure this out, not only will we'll have gas for the next 400 or 500 years, but we'll be putting it into our cars because you'll see a lot of GTL activity. There'll be a lot of stuff that happens that really changes the way the world is. So it's one of those sort of transformative things on the horizon. You don't know when it's going to happen, but you got to keep your eye on that ball. Yes?
Have you got a map of the hydrates?
I do, but I didn't put it in here because I actually just added this slide recently.
Well,
there are a lot of hydrates in the Gulf of Mexico, deep water typically. There's hydrate in Arctic regions, a lot of it. Interesting places too. There's a lot of hydrates off the coast of northern Japan, which is why the Japanese are so interested in it. There are hydrates off the coast of South Carolina, of all places.
There's also some that are actually extraterritorial, aren't there?
Yes.
Which would be a really interesting map.
That would be interesting, yeah. I don't think those would be the first targets, though. Yeah, so.
I comment that the hydrates you're referring to are within 100 meters of the seabed. And this is the issue. You start talking about injecting CO2 to recover methane, and you're displacing the seabed, you're making the seabed in deep water or shallow water unstable. The next thing you know, the methane pops out.
Exactly, that's a risk, absolutely.
I don't see any mining of this until they've got metals, nodular mining sorted, and that's going to take the bid.
Well, the test well that I'm referring to was actually done, it was sub-permafrost in Alaska. So it wasn't offshore, it was actually onshore. So it's a little bit different, but you're absolutely right. That's a major concern because
the actual nodular mining technique. Yeah. And then with coil tube drilling, it might be possible, but they're still in the instance.
Oh, look, that's my point. We're still a long way off. But the point is, there's a technological solution to this out there somewhere, right? And that was the point with shale, right? A lot of what we know about shale today was initiated with something called the Eastern Gas Shales Project back in the late 70s, early 80s. So that's 30 years ago, right? So might not, given what's going on the hydrate front, 30 years from now, we see something very similar happen. I think it's a reasonable question to ask. Okay. Unconventional oil. Not really a major impact for Australia, but it certainly has a major impact for global oil markets. In the United States, where the shale gas bonanza is sort of taken off, we've also been able to identify liquids-bearing shale resources in the U.S. This is important. Why? Because it's all over the place. It's not located in any one specific region. As a matter of fact, there are two places where we actually already see significant production. In the Eagle Ford, which is in South Texas, and in the Bakken, which is in North Dakota. The two regions combined already produce around 650,000 barrels a day. Okay, you say, well, so what? Well, what if I told you 8 years ago it was nothing? Okay. Things happen very, very quickly on this front. A lot of people project, a lot of analysts who are really focused on this, project those two basins will produce over 1 million barrels a day by this time next year. Okay. That's just from two basins. If I then expand my scope and think about all the other places where liquids-bearing shale is known to exist, you can think about the Monterey Basin, which is basically the source rock for the San Joaquin production that is in Southern California that has long been a very prolific region for oil in the United States. If I think about areas like the Tuscaloosa, which is a marine shale that spans across Louisiana and Alabama and the southern part of the United States, that is a liquids-bearing shale. If I think about the Sunni Lane shale, that's in Florida of all places, where oil production really hasn't been that prolific. There have been some small successes, but that shale has been identified, and initial testing of the structure seems very, very promising. So I can continue to expand. The Permian Basin actually has, I think it's 5 or 6 different shales that are all oil-bearing shales at different depths. So it could be a very prolific basin long term. This has really led to a renaissance in oil production in North America. Okay? And this is a really important point for North America because it actually means we don't need to import as much, right? But it's also an important point for the rest of the world because by displacement, that oil is available for consumption in other parts of the world. Okay? Then we start to think about, well, what if this can be found in other places? I showed you that map earlier of the global shales, and in China, there are several points where shales have been identified. Some of them are thought to be liquids bearing, in particular up in the Ordos Basin and the Songliao Basin. These two, if they are oil bearing, are relatively close to the major population centers on the East Coast in China. They're relatively close because there's traditionally been oil and gas production in those regions, to gathering infrastructure and pipeline infrastructure. So if it proves to be a commercial success, it will happen relatively quickly, provided the regulatory incentives are right. Okay. Now, why do we talk about this? Because we know right now, in the last couple of years, we've seen a lot of unrest in the Middle East, right? More generally, the Middle East and North Africa, what we call the MENA countries. Never in the history of unrest in any of these oil-producing countries has unrest been followed by an increase in oil production, or regime change been followed by an increase in oil production. It always goes down, okay? It's a very important point to internalize, because what it means is when you see unrest in these regions, you can pretty much bet that production is not going to grow, okay? Now, if demand is growing, what do you think that means for price? It's going to go up. If you have these upward pressures on price that are largely motivated by internal political strife, then that actually causes upstream developers to start to look to new frontiers. What's the new frontier that people are looking at right now? Unconventional oil. Deep water. Right? So it's oil sands, it's oil shale, it's tight oil, it's deep water off the coast of Brazil, deep water in the Gulf of Mexico. Right? All the same sorts of things that in effect happened in the 70s and early 80s that really pushed developers into the North Sea are pushing developers into all other new frontiers. As long as these pressures exist, you will see interest in these resources. One of the things that happens when there's interest in these resources, first entry is expensive, but we figure out how to do it in a much more inexpensive way. Okay. Yes?
How is, say, countries like Saudi Arabia in particular, viewing all this happen on their doorstep pretty much?
The Saudis have made public statements that prices need to be, I think they've said 70 or in the $80 to $100 range, right? They're in a rough spot, actually. There's a massive proportion of the Saudi Arabian population that is Shia that lives in the southern part of the country where a lot of the oil fields are. They work in the oil fields. And one of the things they worry about is some of the strife that you've seen in other parts, other Arab nations, becoming an internal issue for them. Okay? So you can't necessarily argue that they'd like to see prices even lower, although if the strife wasn't going on, you could make that argument. As a matter of fact, they've made that argument in statements at the Baker Institute before. Because they have a massive amount of oil, they have a much longer time horizon, so their discount factor is very different than, say, the Iranians or anybody else in the region. So the basic idea is that, yes, we'd like lower oil prices because we realize high oil prices incentivize investment not only in substitutes for oil, but other sources of oil. Right? And you run the risk of losing market share. But at the same time, they have to continue to be able to placate the public. How do they do that? With oil revenues. Right? Natural gas, for example, is heavily subsidized. How is it subsidized? With oil revenues. One of the biggest issues they face right now, and this is not necessarily political, but is how do we continue to meet growing demand for electricity? Well, they made a decision not to do gas and actually started burning crude oil in a lot of coastal facilities. In the summertime in Saudi Arabia, they burn 1.1 million barrels a day of crude. Okay. That means they're not exporting. And they sell electricity at 0.7 cents a kilowatt hour to their domestic population. Okay? So it's not a money-making venture, right? And so one of the things they're doing is they're thinking, well, how do we develop our gas resources, which are actually quite large in Saudi Arabia? The trouble is if I develop the gas resources, I've got to sell that into a power facility. Power generation facility is going to sell power at 0.7 cents a kilowatt hour. That means the gas has to be priced below marginal cost. How do you incentivize Aramco to even do that? You don't. Okay. So they're in between a rock and a hard place. They realize they're going to have to do something with internal pricing, particularly given demand keeps growing, and to subsidize something that keeps growing, it gets more and more expensive, right? Which means they're diverting revenues from otherwise productive ventures, say to develop more oil resources. Okay. So there's a rubber meets the road period coming in Saudi Arabia. I'm not as pessimistic as some of my colleagues. I actually think they'll figure it out. But I think that there's going to be a little bit of strife before all is said and done in that part of the world that we don't necessarily anticipate right now.
So I think you would call it a transformative event.
Absolutely. Absolutely, and that's exactly why this is here, right? That's definitely a transformative event. Okay. So where does tight oil fit in? This is an interesting little map. It just sort of ranks the marginal cost of resources. This isn't work that we've done. It's actually from a consulting firm known as Booz Allen. They've used some IEA data to sort of build this. But you can see the light tight oil bar over here. There's a wide range of costs at which this stuff is productive, but it's not a big number. Well, if we start to venture into this and we start to do a little bit more exploration, a little more innovation, what typically happens? The width of that thing grows, and the variation in cost will compress and actually come down, which basically means you can see this thing start to look like this and drop in somewhere right about here. So what that means is you can make a lot more oil available at a lower cost. You actually end up with downward pressure on price. Sort of standard story, right? It's the supply response to high price. Yeah.
5 minutes.
Oh, wow. Okay, so I'm gonna kind of skip through a few things because I think some of this you can sort of read on your own, but a couple of points that I think are the most salient for Australia. I mentioned the EPA's MAC rules, right, and what that actually might mean for coal markets. Well, it's already creating a lot of political strife internally in the United States. As a matter of fact, the Senate actually just held a vote of disapproval for the EPA pushing this through, which is interesting. The EPA, in case you don't know, is actually mandated to, once it deems something a pollutant, to issue a rulemaking and act. Okay, that's by law. It's not, well, we don't really need to do this. It's if there's a finding as a result of the study they conduct, they have to issue a rulemaking, they have to act. It's actually the way it's set up by law. The only thing that can disrupt an EPA rulemaking is an act of legislation. So you have to get through the House and Senate, so the U.S. Congress, and the President has to sign it into law, and then you can actually change the rulemaking, right? In effect, what you're doing is you're rewriting the rules for the EPA, which in effect means it's not going to happen. Okay? So what you have is a rulemaking that imposes that all fossil generation facilities use the maximum available control technology for pollutants that have been deemed health risks. Okay? So once you actually adopt those pollution control technologies, then you can operate just fine. Trouble is, it's going to cost you a little bit of money, particularly if you're an older facility and you're going to retrofit. Okay? In not every case does it make sense to incur the cost. Okay? So what that means is you could see up to 60 gigawatts of coal-fired generation capacity in the United States shut down. It's likely going to happen. As a matter of fact, I've talked to some operators who own both coal and natural gas facilities, and they're already making plans to shutter the coal facilities and build more natural gas combined cycle, okay? Largely because of what's coming down the pipe from EPA. And so you ask yourself, all right, if that's going to happen, aside from the concerns about regional power availability, which is an obvious concern in certain parts of the world, you have to, what's going to happen with the coal? Right? Well, the writing's on the wall. This is a graph monthly from the beginning of 2000 of U.S. coal exports. You can see here relatively flat. There's some seasonality associated with this. This is a unique period. It has to coincides with that ramp up in exports. Coincides with financial crisis. It was a big drop in demand, and so coal, rather than just pile up because it's contracted, is actually exported. But then things recover, electricity demand picks back up, but notice what you start to see. Even though demands are continuing to grow, exports of coal are also growing. A lot of that is actually targeted to China. Okay. Why is this happening? Well, it's happening right now because the natural gas price is around $2.50 and it's competing with coal for baseload generation capacity. All right. Once I add a stressor to that system, like an environmental regulation that makes coal-fired generation more expensive, it's going to exacerbate exactly what's going on right there. Okay? There are already plans to expand port facilities to export coal, expand rail facilities to get to those port facilities to export coal. The coal industry sees what's coming. It is a very large industry with a very powerful lobby. It's not just going to lay down and die, which means the U.S. is likely to become a significant coal exporter in the next 10 to 15 years. Yeah.
How do you think this will impact on WA coal exports? I mean, we don't really do any at the moment, but there is a lot of talk of us exporting in the future. Our coal is very marginal, and we're looking at markets like China. But how do we compete with the US and Indonesia, and with lower gas prices? Do you see WA coal being important? I mean, if Shale comes on board, it could really impact. So.
Sure. I think Australian coal is really not at risk in the next couple of decades. Okay.
But West Australian compared to the Eastern States?
I don't know enough about the relative cost of development, to be honest with you. But I would say in general, in the aggregate, I would not worry about Australian coal, largely because demands in China and India are continuing to grow. Okay? So yes, I'm adding supply. It's like pouring the water on a sponge, right? I can eventually saturate the sponge in which water starts to run off, which basically means water is a free good. And you see, in effect, the price of coal in that instance drop very, very low, and it would start pushing marginal suppliers away. Okay? But in this case, the sponge is getting bigger too. Okay? And so it means there's actually room to absorb a lot of this stuff. What you do have to recognize, though, is that if the U.S. gets into the export business in a major way, it has more coal resource than anybody else on the planet. And that could actually have dramatic implications for the way international coal is, coal is priced internationally and the way coal is traded internationally. So there's a lot of things that could really be transformative about the U.S. entering the export market. All right, so real quickly on pricing paradigms, if you just indulge me for 2 more minutes, I can wrap this up. The threat to oil indexation, this is potentially a very transformative event as well. What you see here is a classic picture of price discrimination. All right, so you get your Wayback Machines and think about when you were doing economics and you learned about pricing of a commodity under imperfect competition is effectively what this is. What you have is a supplier who can walk up the demand curve. You can identify separate elasticities of demand. You can segment consumers, and you can basically say, all right, I'm going to charge you X. Are you willing to pay that? Yes, because I've identified your position on the demand curve. What that means is that this demander here is willing to pay this price, but to the supplier who's supplying that, there are rents to that supplier. Okay. It's generally viewed as an acceptable agreement because maybe there's an energy security premium associated with this, or a volatility premium associated with this, because there's not a liquid market for the commodity, the underlying commodity. Right? Well, what does shale do? It flattens the supply curve. I've already made that statement, right? You get a much more elastic supply curve. In which case, the market clearing price shifts. And this is an important point because you can actually have both contracts and uncontracted sales. It's not an either-or proposition. You can have them both. Okay? Matter of fact, we see that in pretty much every market that's traded. But when price drops because supply becomes more elastic, you actually end up with additional rents in the system associated with pre-existing contracts. With those existing rents, everybody sees them. What does that do? It forces renegotiation. Everybody comes back to the table. A lot of contracts that exist today that are being signed around these new LNG facilities have 3-year reopeners in them, which basically means 3 years from now, if I'm not happy with the rents that you're getting as a supplier, guess what we can do? We can renegotiate the price. Okay? So if shale is a reality in other parts of the world aside from just the United States, this is probably what's going to happen. Okay? And so we have to understand what could really cause this shift. It's not just about, well, the supply curve's flat or so on and so forth. You actually have to be able to present arbitrage opportunities. You have to be able to present liquidity. So you have to have the development of something called hub services. In Europe, you're already seeing that, which is precisely why the oil index paradigm is falling apart in Europe. In Asia, completely different game. Why? Well, because there's no real continental pipeline gas market in Asia. You need that in order to be able to offer hub services because you need access to depleted reservoirs or salt domes so you can actually develop storage. Storage provides you the ability to trade both intertemporally and spatially. That's a very important feature when you want to think about liquidity in a market where demand fluctuates a lot. Okay. So the thing to watch on this front is what happens in China. So we're back to that point again, right? China is potentially a very large market, potentially a very large pipeline market. There's a history of production. There are depleted reservoirs there. All the pieces are in place. Whether or not it happens and how fast it happens that's the issue we have to be concerned with. All right, so future energy demands, just real quickly, just blow through these slides, but this is important because I showed you some history before, which got you up to 2010. Now I'm going to, by country, show you what happens to, this is oil demand. This is projections that we've generated at Rice using some models that we've developed. They're econometric models, but nonetheless, you can see here China, India, Indonesia, Japan, Russia, Saudi Arabia, US, Australia, and all these pictures is a thin black line. Okay. Not big in the petroleum demand sector. Now I've dropped the names on everything except for Australia, but the colors are all the same. So you can see when I look at the natural gas picture, it's largely an Asia story again, right? US, Russia, Saudi Arabia, and here's China, and here's India. Okay. Really driving the steepness of the curve, so to speak. Coal demand. This is the spooky picture, right? So when I look at China, this has already happened. I look at India, growth is occurring there as well. We actually see longer term Chinese coal demand plateauing and its share declining, largely being overtaken by demands in gas eventually and other forms of energy. But you can see here the story is largely an Asian story. Right? And this is my point about Australian coal. Right? This market is big enough to absorb new entry up to a point. Okay? But it really does, it speaks to a point, and I actually put this slide in almost hesitantly because I didn't want to trigger a bunch of debate, but I think there's a point to be made here, right? When you think about what this means for CO2 emissions, you just sort of add up all the fuels, their emissions coefficients, so on and so forth. US, Russia, Saudi Arabia, China, India. Where's the source of growth? China and India. Here's Australia. Very important point. The CO2 problem is a problem of the commons. It's not a problem of an individual country. Okay? Individual countries, however, are taking steps to act with regard to controlling CO2 emissions. Fine, no big deal, but what you have to recognize is that can actually generate some transformative change. Because the change will be affected in the host country, in the country that's adopting the policy, not in the countries that are not adopting the policies. These are very important points, because you can inflict upon yourself transformative change almost as an unintended consequence because there's a benign goal in mind. Okay? What all this stuff means for Australia? Well, on the oil front, not a lot. When we start talking about gas, shale gas, methane hydrates longer term, these could all be very transformative in terms of what they mean for not only Australia's target markets, so end-use markets, but also for pricing paradigms. Because if we add supply, we make the supply curve flatter, we potentially actually alter the traditional pricing paradigms and move away from the oil index paradigm into one which you have hub services and hub index pricing. Well, that could potentially, particularly for the more recent projects that have been announced in Australia, if they go forward, put those projects under severe financial stress. Okay. So it's something just to keep in the back of your mind. Ultimately, if the project is built, the capital is sunk, it will flow, but if it's under financial stress, you could actually see a lot of waxing and waning by the owners of the facility at some point. So as you sort of move past all that stuff, then you can start thinking about, well, what about environmental policies like what the EPA is doing in the United States, what that means for coal competition, so on and so forth. Has implications for Australia, although from what I just showed you, we should expect demands for these fuels to continue to grow so it can sort of absorb this sort of new points of competition. It doesn't mean there won't be some interesting conversations at the negotiating table. It just means you have to be aware that you're going to have new entry into this market. And then the last thing I'll state, I already talked a little bit about Fukushima. Nuclear policies in general are always a wild card. They're very much political animals themselves. and how that shakes out, particularly in Japan where all the reactors are shut down, what's actually brought back up long term, and whether or not there are any plans for new construction. It's very much on the table, and it has dramatic implications for LNG demand. Finally, carbon policies. These are always a wild card because they definitely are transformative in terms of the types of fuels we consume, and the types of fuels we consume will dictate the types of fuels we produce. Okay. With that, I'll end. I think I ran over a little bit, but I appreciate your attention.